I'm here with Warryn Robertson, Portfolio Manager at Lazard Asset Management. Warryn, thanks for speaking at the Inside Network's Equities and Growth Asset Symposium.
Great to be here.
The tagline of the event is Sailing Through the Headwinds. In your opinion, how should advisors try to achieve this?
Look, I think the two major headwinds we have today are inflation and the risk of a recession. And if you think of what type of investment would work in that sort of environment, Warren Buffett once used the term of the ideal investment as an inflation-linked bond with rising coupons. So it has, think of infrastructure in that construct as having explicit or implicit inflation protection, bond-like because it's an essential service. So yeah, it goes about our daily lives and so isn't fluctuated by the risks of recessions as greatly. And rising coupons because these are businesses that can reinvest in their asset base or just through increased patronage will grow earnings in real terms over time.
So infrastructure as a sector has a few interesting connotations, least of all the challenge of attributing a relevant benchmark. Could you quickly cover why that might be the case?
Sure. So going back to the first question, inflation-linked bond with rising coupons, investment characteristics. The problem with the benchmarks is they're fixated on the physical characteristics of infrastructure. And there are differences. So I have about 400 infrastructure stocks that are listed on publicly traded markets around the world today. If you used Buffett's analogy of the ideal investment over the top, less than 100 would fulfill that criteria. So the benchmarks, unfortunately, are full of stuff that doesn't have that inflation-linked bond with rising coupon return profile.
Okay. So infrastructure investments can sit in many areas of a portfolio. The lines get blurred there a lot. What guidance do you have for an advice practice trying to reconcile where to include it and what role it can play?
Sure. If I look at our book of business, we manage $25 billion now on behalf of clients around the globe. And they use us in different buckets. So if you think about us in terms of defensive global equities, that's how we are used. So we downside protection of about 60%, equity betas of 0.7, 2/3 of the standard deviation of a typical equity portfolio. You could be in a discrete infrastructure allocation. Or you could also be thinking of it in terms of, well, we're looking for bond-like risk, but we're prepared to take a little bit more to get additional returns. And so we find ourselves used in many different ways. But if people think about us as sitting between traditional equity risk and bond risk in that space in the middle, that's where you could use us in a client's portfolio.
Yeah, I guess a lot would depend on how the portfolio is constructed otherwise. Many advisors are interested in avoiding regulatory and ESG risks. How can infrastructure investments support this?
Regulatory risk is the key risk you bear. So if you think about it, these are physically constrained assets. So you can't pick up your toll road and move it if the government decides to change the rules, right? And so that's why we caution investors looking at infrastructure in many emerging markets around the world. ESG risks, if you break that down into the three letters, essentially you've got environmental, think of the carbon, the energy transition. Infrastructure is a key part of that. The social contract is really important with infrastructure. How much can a regulator allow asset owners in terms of the financeability of the asset? How much can they allow them to generate without making affordability a problem for consumers? And then finally, governance. Now, if you think of these assets, they're quite simple to operate, simple to run. The key risk you bear is to be concerned about management and the poor allocation of capital. So we fixate ourselves not only on carbon risks, not only on that social contract, but how well management has proven to be stewards of capital.
And final question, what do you think could be the big market surprise in 2024?
I think everyone's now sort of put behind them the risk of inflation and they've put behind them the risk of a recession. I think there is still now this is a tightrope that central banks have walked and have done an incredible job, but we're not out of the woods yet. So I would caution investors to just be carefree and not worry about those two major risks that we see today. If you are worried about inflation, you are worried about the risk of a recession, then infrastructure is a safe haven in those types of environments.
Warryn Robertson, thanks for joining us.
Pleasure. Thank you.